Hey there, Blockhead traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of January 3rd, 2026. And in this week's episode, first episode of 2026, we're going to round out the little series that I've been doing of trading and tax status, specifically diving into the trading tax status designation by the IRS and what those implications are and how it completely negates the need for a wash sale and what really to consider when deciding on if you're going to file your taxes with a trader tax status, on if you qualify, should you qualify, and does it even make sense? So that's all in this week's episode. But before we hop to that, I want to give a shout out to the Discord, a link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. I love to hear what type of content you want to hear about. I love to hear what you're trading. Also, you can find a link to thetagang.com/Sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts, so look us up, subscribe, and if you can't find it there, let us know and we will get it there. But let's hop to this week's content. To the conclusion, kind of the wrap-up and reflection of my 2025 tax year status, and it's the culmination of looking at tax loss harvesting, how did I do in the year, what did my strategy yield, and how can I optimize and tweak this going into 2026. And the part of that I want to touch on here is a thing called trader tax status. And that's very important because it completely changes how the IRS views your trading activity, what you can and cannot do. So before we kind of hop into that, I want to kind of maybe frame this up as a distinction between a hobby and a business, where trader tax status is really where you're kind of taking your game to the next level as far as how does your trading activity play into your daily or yearly income. And if it's more of kind of a hobby that you dabble in a little bit to invest and build stuff up and kind of a holding over time, trader tax status probably doesn't make a lot of sense for you. But if this activity really is geared around making an income for you and being a supplemental income, and you're doing it with a lot of frequency and a lot of volume, there are a lot of benefits that could come from a trader tax status. And we'll kind of dive into some of those, more so on how it pertains to me and the reflection that I've had on my trading style and where I think it really fits in. Now, just before I jump into this, I do want to put a link right up above. There's past episodes where we kind of talked about some of the concepts leading up to this, notably mark to market. So I won't go into a lot of the detail on mark to market. I spent last week kind of talking about mark to market. And then the week prior to that, I also spent some time just talking about my particular tax end situation and how my strategy really panned out for the year of 2025. Now, I'll recap some of that in summary here, so that might not be as important, but the past two episodes of Blockhead Traders you might find useful. So let's start off with the term trader tax status. Now, this is an interesting term because there's not really a formal designation for, hey, I am a trader, IRS, please treat me as a trader. There are two pieces that are often conflated, but are actually separate entities and are mutually exclusive. So there is trader tax status in which there is no formal declaration at all. And then there is another thing that's called mark to market, which we talked about previously. That is a formal declaration to the IRS, and that formal declaration has to be made in the tax year that you want to use it in. So, for example, if I want to use mark-to-market accounting in 2026, I need to file that declaration with my 2025 tax return. So that is by April 15th, 2026, I have to file an IRS Form 3115 to elect mark-to-market. However, to go with a trader tax status, I simply need to file my taxes as if I'm a trader. And you can often do trader tax status without mark-to-market accounting. On the flip side, you can be a trader tax status and take advantage of mark-to-market accounting. And really what I'm going to dive into in this episode is kind of what I plan to do in the tax year of 2026. And that is, I am leaning heavily towards mark-to-market accounting as well as filing my taxes with a trader tax status. Now, trader tax status is like I kind of alluded to, when your trading is more like a business, you will often find that trader tax status is very beneficial to you and the endeavors that you have. Most notably, the biggest benefit is all of your trading expenses, all of your market subscriptions, your data fees. You can even probably a portion of your home office if you work from home for this activity. All of this stuff basically becomes a business to the IRS. And once it becomes a business, all of your trading activity flips to what's known as ordinary income. Now, that's important because once it's ordinary income, there's no capital gains designation to it. So there's no limit to how much you can write down from losses. When you have a business, the IRS doesn't say, oh, you ran an unprofitable business. I'm sorry, you can't take advantage of your unprofitability. You basically can take full advantage of all of your losses. Now, on the flip side, you also have to be fully accountable to all of your gains. And that's where this trader tax status really, really depends on what type of trader you are and where a lot of your gains and losses tend to be from. Because with a trader tax status, you heard me talk last week about wash sales. And wash sales basically are where the IRS says, hey, you have booked a loss. You may not re-enter that position for 30 days. If you do, you may not deduct that loss. And as an active trader, you're constantly catching these swings of price from day in to day out. And if you deal with a lot of those wash sales, you want to be able to take advantage of those losses that you book. And the only way to do that is to say, hey, I am a trader tax status and file your taxes as such. In my particular case, I don't actually have a ton of wash sales, but I do have very high frequency trading. When high frequency, I mean multiple trades a day and a week. Often, sometimes in a week, I will have dozens of trades around earnings. You heard me always talk about earnings. Earnings are a very binary event. I'm in before the earnings. I'm out after the earnings. And with my particular strategy, what ends up happening to me is I have a very high percentage of realized gains because I'm constantly booking my profit as I go along. And when I have losses, yes, there are times when I book the losses, but a lot of times those losing positions don't hit my bailout threshold. And I end up hanging on to them as they kind of recover. So what that basically means is if you kind of think of somebody processing anything, right? And you got some sort of screen and some sort of filter, your profits are dripping through into your bank account. And then what's left above the screen are kind of those losses, which means at the end of every year, I have a large quantity of unrealized losses because those are the positions that haven't quite hit my profit targets yet. Well, I have a large bag of profits underneath that filter that I've been filling up throughout the year. Also around the benefits of the trader tax status, as far as the ordinary income and ordinary losses, your income, your profits, and your losses treated as ordinary income, basically allow you to fully take advantage of all the losses that you've booked over the years. So if you have a bad year, you basically can deduct that from your tax obligation for you as a trader tax status if you're in excess of a losing year. Now, that's not so beneficial if you never really have a losing year, right? Because then you're never a net negative. But what also comes with it is the benefit of the wash sale, where wash sales don't really matter and you don't need to keep track of the wash sales. You can enter and exit and re-enter positions as often as you would like. That really allows you to swing trade. That allows you to take your big losers and fully deduct them as ordinary income losses. Of course, big winners get logged as ordinary income. So this can be very beneficial if you happen to come across a disastrous year where you have a net losing position in excess of $3,000, whereas under the capital gains or non-trader tax status, you're going to have to keep rolling those losses year after year after year before you can fully book all of them because you are limited to just $3,000 in losses a year. Now, there's an additional thing that makes it a little more interesting for me, and that is the mark-to-market declaration, which we'll get into in just a minute. Now, there are additional expenses that come with trading in such a high frequency, particularly if you leverage margin. You're going to have margin interest expenses. You're going to have data fee expenses. You might have training expenses that you want to do. And if you have a trader tax status, all of these things become basically business expenses, which can be deducted off of your income, off of your profits to basically help offset some of that. So not only can you deduct your losses, you basically can count all of the things that you do as expenses to achieve that. Its trader tax status is essentially kind of saying, hey, IRS, this is part of my business. This is an income stream for me. This is not just a hobby. This is not just a wealth building exercise. This really is a business. Now, the IRS doesn't just sit around and say, oh, cool, you want trader tax status. Cool, we'll give it to you. And there is no formal declaration, so they don't really review it. But you effectively just file your taxes as if you have trader tax status. And if the IRS doesn't think so, then they will let you know through an audit and kind of call that out. So it's really important to kind of think, well, what does the IRS really look at when they're looking at someone who has filed their taxes with a trader tax status? And so I kind of put together this little chart, this little table here about things that they consider. There is no hard and fast concrete definition. I think that's one of the drawbacks or gray areas when it comes to trader tax status. But effectively, kind of looking at this is a good guide on if you are a trader to qualify for a trader tax status. And part of that is how much time do you spend trading? A day, a week, a month. So the more time that you spend on that, the more it helps, or the more it puts the ball on that side of the scale that says, hey, I'm a trader. If you're actively getting in trades every single day, that is much more. If you're only getting into a trade maybe once a month, then that's not as strong. Doesn't mean that you can't be considered a trader tax status with monthly trading. It just means that you have less of a strength of a case to lean on. What are your typical holding periods? So if you look at your portfolio, how often are you holding a position? Are you holding a position for 5 minutes, 5 hours, 5 days, 5 months, 5 years, right? All of these things kind of factor into what is your time horizon. Trader time horizon, as you've heard me talk about on this show, is very, very short, usually on the order of hours, days, maybe weeks. Once you get past weeks, you're really kind of getting away from a trader status and more into a potential investor status. And it can get kind of gray because you can do swing trading on larger intervals, right? There's not just swing trading intraday. You could do swing trading monthly. You could do swing trading on any time horizon. And we've kind of touched on that when we've done price action charting. The next one is, what's the frequency as it pertains to the dollar amount? Are you chucking around, $2,500 a year in your trading? If so, then that's really probably not a reliable or a strong case for this is a business, because no business is really operating on $2,500 a year in revenue and stuff like that. Now, if you're kicking around 25,000, maybe you're getting a little bit more, but that's still a little bit kind of low. There's no definitive value that says, oh, you must be trading at least X dollars. There is often a interesting threshold in most brokerages to get what's known as portfolio margin. That usually is between $100,000 and $150,000. Each brokerage can kind of decide what that is. Being over that limit puts you a lot more in the camp of, hey, this guy might really be trying to do this for a living, as his volume, his dollar amount is much greater and much more in the line of, this is a business, here's annual revenue, here's annual expenses and all of that stuff. So where are you seeking to profit from? And this kind of goes to the holding period. If you're really seeking to profit on short-term moves, you're a lot more in the trader camp, right? Which is equating to your holding period. So I do a lot of earnings trades, right? Where I am in and I'm out. I am seeking to profit off of that one singular binary event. That is very much a trading activity. Now, if I am trying to go long on good earnings and hold positions for many, many months post earnings, that is less of a trading activity and more of an investing activity. Now, again, similar to that previous comment I just had around the volume, is the activity substantial in comparison to your income? So how much of your total income is really relating to activity? the more that the trading income is a percentage wise to your overall income, the stronger your case is to say, look, this is my business. This is my day job. I am a trader. And the other one is, how repeatable, how regular are you? Is this a thing that you did for 2 months and then you disappeared for the other 10 months of the year? Is this a thing that you consistently do with pattern in and out, in and out? And all of these factors that are on the screen, the IRS really takes into consideration if they're going to challenge that trader tax status to you. And so you kind of want to have strong footing on this in case of an audit. So, the obligatory, I am not a financial advisor, really comes here, and go seek a certified public accountant's opinion or somebody there that can use a lot of your trading activity to help validate if you indeed qualify what they think probabilistically for a trader tax status. A lot of it is pre-existing cases that have been brought before the IRS, different challenges that they've had. There's a whole myriad of that type of things. And those CPAs and those financial advisors will be a lot more knowledgeable about that, where if you go speak to them, they would give you a much better idea of how qualified are you for that trader tax status. I did some reflections on my trading within 2025 to kind of reflect back to say, hey, what type of trading did you do? What was it relative to your portfolio size, your portfolio composition, and kind of reflect. So I downloaded all of my trades. I kind of analyzed them. Within 2025, I made just a little bit over 700 trades throughout the year. Those were very, very clustered around 4 times a year around earnings events, because that is the largest thing that I play. I do have binary events that were kind of sprinkled throughout there and other theta burning plays. The average holding time of each of my positions was between 7 and 14 days. So between 1 and 2 weeks. Not quite as frequent as a day trader, but it is very frequent versus an investing. And if you look at what my average composition of hold period is, whether they were short-term positions or long-term positions, like 98.5% of all of my portfolio and all of my gains and all of my activity was centered around less than a year. So it's all short-term profit and loss. So very, 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 very little long-term. There was a few things in there that are just kind of holding things that were in my portfolio from before, but it's not really part of my strategy now. But they're just kind of positions that have been there, and I haven't kind of closed them out and converted all of that over to that daily trading and that trading tax status type activity. Now, the other piece of that is, how is that represented from your profit and loss relative to your income? Because this is, as it's no stranger to anybody that's watched this episode or this series much, is this: I got into trading specifically to augment my income, specifically to say, is this a viable living option for me in retirement, where I don't just rely on the nest egg that I have provided? Can I do something active that's interesting to me to generate a secondary stream of income versus the money that I've squirreled away for retirement? So my whole strategy that I've looked for was to make this a income-based operation. And so very much the intent and all of the actions that I have put forth really put me, in my opinion, in that trader tax status. Now, the bigger piece for me is the mark-to-market accounting. And the reason this is a bigger piece than the trader tax status is, yeah, cool, trader tax status is awesome, but I'm a profitable trader. I have been a profitable trader basically every year since I started in 2019. I have never had a losing year. I had one year that was almost a wash, but I was just edged out a little bit on the profitability. So I've never really had kind of a large losing year where I was in excess of that $3,000 limit to be able to deduct. So the trader tax status doesn't really benefit me a ton when it comes to that aspect of things. Now, where it does benefit me is the wash sale consideration, where I don't have to worry about the wash sale. I can go ahead and buy and enter positions. I don't do a ton that way. I do a lot of earnings short-term moves, but sometimes I like to exercise the price action and do quick swing trades and stuff like that intraday. And those things, I can't count any of those losses as realized losses because I re-enter as wash sales. So for me, there's a little benefit on the wash sales, but that's not a huge part. What is actually a bigger part, and this is independent of a trader tax status, is the mark-to-market accounting. And the mark-to-market accounting, as we kind of talked about in the past, is where at the end of the year, it just pretends that all of your positions are mark-to-market, whatever they are. That just goes into your tax bill at the end of the year. You don't have to close those positions to realize the losses, whereas without mark-to-market accounting, you would have to close them to realize the losses to offset the gains. Now, you might think, well, why is that important if you're such a profitable trader? And it kind of goes to this, if you picture a filter and you picture things landing on top of the filter, this is your profits and your losses unrealized. They're all hitting this filter. And that filter is designed to only allow you to lock in your realized profits. So your realized profits go through the filter and they go into the bag. That bag is your profit bag. Everything then that sits on that filter, that screen, is kind of curating out. Those are unrealized losses that tend to be there, because as soon as you have unrealized gains, you go ahead and you cash them in and you let those profits fall through. What that means for me is my particular strategy is book your winners right away. And some of the losers do get booked right away, but a lot of times my exit strategy, I don't hit that. And so I end up having a large number of these losers caught in this filter, which isn't a bad thing. But what ends up happening is at the end of the year, I have a very high number of realized gains and also a very high number of unrealized losses. But I can't actually do anything with those unrealized losses because I'm not doing mark-to-market accounting, which means I pay a very large tax bill on my realized gains, even though I've already kind of given back a lot of those gains in unrealized losses. So I have a little example here to show you. And what I have here is one with mark-to-market accounting and one without mark-to-market accounting. Now, these numbers I just kind of made them up fictitiously because they help prove a point on why mark-to-market accounting can be very beneficial if you are a person that ends up holding a lot of these unrealized losses at the end of the year, which is exactly my strategy ends up surfacing. So let's say throughout the year of my closed trades, I made 175 grand in realized profits without mark-to-market accounting. Let's say in my bag, in that filter that I'm talking about, I have $120,000 of unrealized losses, open positions that I'm not done with, but just based on the timing of the year is over, but those haven't matured. Maybe I just entered them and they're not panning out, or maybe they were carried over from the previous month or whatever. There's $120,000 of unrealized losses. If you don't have mark-to-market accounting, I have to pay the 35% short-term rates on that $175,000, which gives me a $61,000 tax bill. Even though I have 120,000 of unrealized losses. My actual profit, right, if I was to liquidate all that stuff, would only be $55,000, which means I'm paying 111% of my actual profit to taxes. Well, that doesn't make very much sense. Now, if we take that same situation and we look at mark-to-market accounting, how does that flip the script? How does that change what we're doing? So again, I have that $175,000 of realized gains, and I have $120,000 of unrealized losses. Well, with mark-to-market accounting, you go ahead at the end of the year and you take that $120,000 and you offset it on your $175,000, and then you only have to pay 35% of that $55,000, which is if you took all your positions mark-to-market, which now makes that tax bill about $19,000. So $61,000 in taxes versus $19,000 in taxes. So now you have a tax savings of about $42,000 simply by doing a different method of accounting. So that really brings us to the end of this week's episode. And what that means for me is I intend to make the market-to-market declaration with my taxes here in 2025 or 2026 when I file my 2025 taxes. The reason I'm doing that is because I have this disproportionate number of unrealized losses at the end of the year just based on my trading strategy. And that's exactly what the mark-to-market accounting is there to do, is to facilitate those traders that are booking their profits all throughout the year as a source of income and offset that income of that unrealized losses at the end of the year without having to close those positions. Now, in the past tax year, I went ahead and closed a lot of those positions and then reopened similar positions because I don't have that mark to market and I needed to realize them. But that's a whole unnecessary step that I don't want to have to take each year because if I have to take that step each year, you can get bad fills because of liquidity based on what the position is. You have to find, if you don't do the trader tax status, then you have to find similar positions because you can't enter the exact same positions because you're not done and you have to deal with a wash sale. So in the tax year of 2026, I do intend to do mark-to-market accounting, and I do intend to also continue to file my taxes with a trader tax status to allow for that deduction of expenses when it comes to margin interest, different fees, data subscriptions, different trainings. I get all of my information from different news feeds. All of those things are basically necessary for the business of trading, and under trader tax status, those are all deductible. And so the combination for me makes a lot of sense, in my opinion, to do trader tax status and mark-to-market accounting. Now, you have to be extra careful here with mark-to-market accounting because if you are a buy and hold type of person, you are going to get murdered on taxes because you have to declare all of your holdings as mark-to-market at the end of the year. So if I ended up having very large positions that I'm carrying from year to year to year, I have to pay full short-term tax rates on those positions, even though I'm not closing them. Now, in my particular case, that doesn't apply because 98.5% of my portfolio is all short-term based anyway, which is exactly what the mark-to-market accounting is going to treat it as ordinary income, whether it's mark-to-market or capital gains, because they're all less than 12 months. And all of my longer term stuff I do in retirement accounts. I don't ever have that in a brokerage account. But if you had any of that, you really need to consider that because you're going to end up paying a lot of extra cost if you end up doing any sort of long-term holdings in there. So it is 100% acceptable to have a trader tax status, but not declare mark-to-market accounting. That really just depends on your particular situation and what makes sense based on how you trade and based on what's most tax advantageous to you. This is something that I spent quite a bit of time over the past month or so reflecting on, diving through all of the data to kind of come to this conclusion where mark-to-market accounting I feel makes sense for the way that I trade. And this is not the way that I've started trade in 2025, right? I've been trading this way since 2019. So this is very much my strategy, my bread and butter that I go to. And so that mark-to-market accounting makes a lot of sense in my opinion. So hopefully this gives you some insight, at least maybe spark some curiosity that drives you to do some of your own research. Like I said, go seek some help from professionals here. I most certainly am not, even though I might have stayed at a Holiday Inn Express last night. So see what makes sense for you, your situations, and what you're comfortable with. Otherwise, good luck out there in 2026. Have fun, and remember, think outside the block.